We've got strategists kind of going in different directions. I think Jonathan Golub at Credit Suisse getting a little more cautious. Mike Wilson at Morgan Stanley raising his price targets. What's justifiable to you here?
Well, I think that the combination of vaccine news and just general human desensitization, where we're seeing, Google mobility or Fed mobility indices basically are showing less and less of an impact amongst the populace in terms of lockdowns. There's just this half-life of fear that's pretty short. I think the combination of those two are pretty evidently bullish for a lot of the value plays, and that's being articulated in the markets today. But I do worry about two things. One, incoherence of fiscal policy going forward with gridlock in Washington, D.C., and also Chinese policymakers starting to signal potential turn to hawkishness in 2021. And that's something to watch and worry about for the long term. I think the 10-year yield is telling you that it's still cautious in terms of the sort of reflation trade.
Marco, let me just follow up with you. I mean, each piece that you mentioned there is interesting, but when you say that there's not as much of a reaction among the population to the spread of COVID right now. I mean, we have seen it in the high-frequency data, everything from TSA numbers to OpenTable. J.P. Morgan's Chase card spending survey has turned over again. Are you saying that you just expect those to be muted declines, but they're certainly happening?
They're happening, but compared to February and March, they're much lower degree. And if you look at something like the Oxford University Stringency Index in terms of policies around the world, the increase in different policies in lockdowns relative to what happened in February, March is just much, much more muted. And so I think the combination of vaccine and just the market is sniffing this desensitization that's playing out in the populace. I mean, I'm out here in Santa Monica. You couldn't have a more, pro-science place in the world, if I can put it that way. And, the bars and restaurants are filled with people. So clearly, relative to what happened earlier this year, there's just desensitization kicking in.
All right, Phil, let me turn to you, bring you in, and maybe you can give us your plays. Marco just said he likes the value part of the market. Do you?
Yeah, Kelly, this is an ideal environment to be overweight stocks. And when we say that, we're overweight about 10% in our portfolio. So in a normal 60-40 type portfolio, we have about 70% equity. And Kelly, I think there's certainly a lot of optimism in the market. There's also a couple of things in the near term that are uncertain around the virus. But here's the three things that are most important in the near term. First is credit. I mentioned the overweight to stocks, but credit also makes sense. Things like high yield, things like non-corporate credit, securitized credit, that all makes sense in this environment in either a low growth or a really good outcome. The second thing is the consumer. The consumer is in awesome shape, Kelly. You're talking about savings rates that are double where they were in November of 2019. So the consumer is setting up for a really exciting holiday season. If the summer was any indication, consumers are going to spend. Maybe they won't go on vacation or the cruise just yet, but they're going to spend on holidays. And then the third thing, and Marco was talking about desensitization. I think if you do see some sort of pullback in economic data in the fourth quarter, this is going to be the mother of all look-throughs to next year, where there is a light at the end of this tunnel, Kelly. And with all this money piled up on the sideline, $1 trillion in cash and money market funds, Kelly, this is an ideal environment to be overweight stocks with this new global cycle.
Shepard Smith here. Thanks for watching CNBC on YouTube.